Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 challenge, and this is number 89, all about the bank of mum and dad, and part two. And there's my disclaimer: facts and figures, information only. This is not advice. Okay, in our first part of this little section, we were said don't do anything. Well, now let's start looking at some of the things we might be able to do for them. We could just give them the money. They need some extra money to get their deposit together, and we just turn around and we give it. Now, of course, this is, can we afford to give it is obviously the third question, and we were talking about this in the last section. And if we can afford it, then why wouldn't we just give them the money? We've got hurdles of money. We're never going to spend it. Nice problem to have. But then we just said, okay, we might as well give it to them rather than giving to an inheritance. We'll give them to now. Now, is that sensible or not? Well, it's going to really come down to a lot of things. It's going to come down to your relationship with the children and possibly how many children you've got and so forth. A lot of personal things will come into this, whether this is a good idea or not. If it is indeed part of a early inheritance, so basically one child is going to get their money now to help them into the house, but the other couple of children perhaps don't need the money, then perhaps when the inheritance and when the will is created, then we basically then restructure our estate to make up for that difference. Now, of course, if you're going to do that, it really needs to be spelled out to the child at the time receiving the money, so they do understand this is part of their inheritance. They're saying, look, okay, you're going to get this benefit now. The other two kids don't need it at the moment, and so therefore the inheritance is going to be adjusted in the future. Now, I think that needs to be spelled out, because there'd be nothing worse than it sort of being a bit vague, and then you die and all of a sudden you're leaving larger money to two others, and the other one said, well, how come, what happened to me? And they're not sort of realising that the money that they got for the house was part of the money. Now, you may not need or want to adjust it in retirement. It could be just a case of you are helping one child, but it's always very, very difficult if you're going to give it to one without assisting the others, irrespective of the other situation. If you're going to give them the money, is it a gift with absolutely no strings attached? So say, here's the money, you do with it whatever you want. Ideally, it's for the deposit of this house. You can go ahead and do it, and there are no strings attached to get the money back. There's no strings on basically what they indeed spend it on. They could indeed go on holiday with it if if they so decide to do so. That's a little bit it's generous, I suppose, but generally speaking, if it's a large amount of money, then I must admit I probably would be suggesting, what the purpose of this money is indeed for. But of course, as we've been talking in these last few sessions about mortgage insurance and all these sorts of things, if we can indeed assist them with this deposit and it reduces their need for the mortgage insurance, we could indeed be saving them tens of thousands of dollars. But as I say, we'll only be giving them money if it's not going to impact us in any significant way whatsoever. We can't afford to give them the money if it's really going to impact on our own retirement, that's for sure. So how much are we going to give them? So where do you stop? Where do you stop? It could be a case that you consider your net assets. So you say, okay, look, we could afford to give 1% away, 3% away, 5% away. 10%, just comes, you can do it on a sort of a percentage basis so that okay, yeah, look, if we've lost 10% of our money, it means that in theory our income could be 10% down. So how does that impact us in retirement? So you can actually do some quantitative sort of analysis as to what impact this money would indeed do. So 10% of 100,000, 10% of 10 mil, bit different. But in theory, it's really the same to the people, to you. If you've got these large assets, 10% is a 10% impact effectively on your lifestyle. So, if 10% is going to hurt you too much, then okay, we look at 5% and so it goes on. But I think if you just take a dollar value and look at what that is as a percentage of what you are living on, then you can actually start to do some sensible calculations. What about a year's pension? What about a year's pension? The meaning that, okay, now does that mean that you're going to die a year earlier? It's just a way of looking at these things to sort of put some sort of value on it, as to say, well, that really does mean that's a year of our income. That's a year's pension. Means that money may run out a year earlier. And this sort of highlights what you're actually doing here, so that you can, rather than just saying, okay, we'll give them 20 grand or 50 grand, sometimes that just that dollar value may not mean much, but when you put it in perspective of what that really relates to, as in a year's worth of pension, then we start to get an idea of can we afford that or not. It's going to be a little bit driven by the liquidity of your assets, meaning that if it's a case that, especially if we start talking about lending the money, if we're taking it out of super, can we indeed get it back in again? So this can be a problem. And of course, if you are, if you haven't actually retired yet, or let's imagine one of the partner, your partner is younger than you, and you've got the money in their superannuation to basically, so it's not an asset for settling purposes. You can't even get that money out, because in theory, if they haven't retired, it just comes out all sorts of scenarios whether you can get the money out and whether you can get this money back in with all the rules of superannuation. So it can be a little bit of a problem as to where this money may indeed come from. Be very careful about redrawing from your mortgage, because you might say, okay, let's pull $50,000 out of our mortgage, and look, we're paying interest on that, but we can afford that. But what happens if interest rates go up even further? And that's going to put pressure on you if you're the one that's actually, repaying it. If you can't afford, if you don't have liquid money, then unless you can get this money out later on to pay the debt back, the last thing you really want to do is be redrawing money and having a debt so that you can help your kids out. I'm sorry, but that just doesn't make sense. It just doesn't make sense, but I get to see it far too often. You don't want to be putting yourself into debt to help your children, okay? I'm tough, I'm tough, but I really get to see, unfortunately, people who really put themselves in a difficult situation trying to help. Now, it's nice to want to help, but you've got to be in the situation of being able to help. Now, of course, if we lend them the money, at what interest rate are you going to lend it to them? Zero interest rate? So you just say, we'll lend you the money, no interest rate, you just got to pay it back. Or is it discounted, meaning if current interest rates are at 7%, you can pay us back at 3%? Or if they're going to pay it back at the current interest rate and have a variable rate just like a bank? It really comes down to your situation there, that if it meant that you can lend them money, but providing they paid it back at a regular rate, you could be living on the money that they're actually paying you back. So you don't need to have the asset yourself. The money the asset could have gone across to your kids. They've used it to buy their house, but so long as they can afford to pay you back at a reasonable rate that replaces that money, the earnings on it, then just imagine you had some money that was invested and you're pulling it down at, say it's earning you 6% and you're pulling it down at 6%. Well, as long as you lend it to the kids and they're paying you back at 6%, you wouldn't be any different off. You wouldn't be any worse off. So there are certainly ways of doing that, but it does come down to, how generous are you? Just lending the money, you want the money back, but there is no interest and so forth. That's just totally up to you, what you need, what your circumstances are. But I think the other one is really the repayment term. Are they going to pay this back in a year, 2 years, 5 years, 10 years, 20 years, the term of a normal loan? Because if there is no repayment term, then it's a gift. If you haven't told them you want this money back within a certain period of time, well, then obviously that is just a gift. and then there's no pressure for them to pay it back, and chances are you'll never get it back. I'm being harsh, but I think that's just reality. If they don't have to pay it back at any time, they'll just say, "Oh, Mum and Dad don't want it back. We'll worry about that later when our bills are reduced, and when by that time you'll be dead and buried." Is it a formal agreement or is it verbal? I would strongly suggest that it is indeed a formal agreement, especially if they've got some sort of relationship. Just imagine you want to help your son out, but the son's married, and then what happens if that relationship breaks up? If they've been together for more than 12 months or so, obviously, even in a de facto relationship, the ex-partner could indeed take half the money. If you've just turned around and given your child $200,000 for a deposit on their house and they split up, then in theory, that ex-partner is going to benefit from that contribution. So if you make it a loan, even if you intend to give it to them, if you actually make it a loan with a formal agreement, and part of the agreement is, should there be any separation, this money has to be paid back instantly, then it obviously means that the ex-partner can't walk away with the money that's taken into account as part of their separation. So you can protect yourself to ensure that your money has to be repaid as part of the family law split for their relationship. And that's why I strongly suggest a formal agreement. So the last thing you want to do is to give money to some person you've probably never liked in the first place. So, please get a formal agreement. Talk to someone who's done this, with a legal firm to set it all up, so that you are not going to lose your money by giving it to a child and then their relationship falls apart. And of course, if interest rates do change and so forth, are you therefore going to change interest rate for them as well? All of these things need to be agreed on, and so that there's no surprises down the track. That's the situation. Agree now, get it all sorted out, get everyone to think, yep, this is going to work. Cover your butt basically by having some sort of an agreement that spells it out. This is going to be paid back, because as a loan, at least you can get it back. If it's just a gift and it's just verbal, then if things change, you probably will never get the money back. Talk to someone with the legal expertise on it, or if you just want to come and have a chat generally about how all this can work and other ideas, more than happy to have a chat about it. Talk to you on the next session.